Hey friends of future millionaires, Gregory Pierre Louis here, the backpack entrepreneur. In this video, I want to talk to you guys about knowing when to buy or sell a specific currency pair, okay? You see, Forex trading involves positioning yourself in the market to capitalize on which currency will rise or fall versus another currency, right? So how do you know when to buy or sell a currency pair? See, that's a good question. And in the following examples, we're going to use a little bit of fundamental analysis to help us decide whether to buy or sell a specific currency pair. And by the end of this lesson, you're going to have a solid foundation and a good understanding when you're looking at the charts of exactly when to buy and when to sell a specific currency pair, okay? You see, the supply and demand of a currency pair changes due to various economic factors, which drives currency exchange rates up and down. And that's what you're looking at when you see the charts, okay? You're looking at price action moving up, down, and sideways, all right? And each currency belongs to a country or a specific region, right? So fundamental analysis focuses on the overall state of the country's economy, such as productivity and employment, manufacturing, international trade, and interest rates. So right now, I need you to wake up. Wake up! If you always fell asleep during your economic class, or just flat out skipped economic class, don't worry. We'll cover fundamental analysis in a later lesson. But for right now, try to pretend like you know what's going on, okay? So let's take this Forex quote right here. Euro USD. In this example, the euro is the base currency, right? And thus the basis for the buy or the sell. And if you believe that the US economy is going to continue to weaken, which is bad for the US dollar, right? Then you would execute a buy on this Forex quote, Euro USD. And by doing this, you've just bought euros with the expectation that it will rise against the United States dollar. But on the contrary, if you believe that the United States economy is strong and the euro is going to weaken against the United States dollar, then you would execute a sell order on the Forex quote, Euro USD. And by doing this, you've just sold euros with the expectation that it will drop against the United States dollar. Let's take another Forex quote, for example. Let's use USD JPY. And in this example, the United States dollar is the base currency, right? And thus the basis for the buy or the sell. Now, if you think that the Japanese government is going to weaken the yen in order to help its export industry, which would be bad for the Japanese yen, then you would execute a buy order on the Forex quote, USD JPY. And by doing this, you've just bought United States dollars with the expectation that it will rise against the Japanese yen. And on the contrary, if you believe that Japanese investors are pulling money out of the financial markets here in the United States of America and converting all of their United States dollars back into Japanese yen, and if you believe that by the investors doing this, it'll weaken the United States dollar, then you would execute a sell order on the Forex quote USD JPY. And by doing this, you've just sold United States dollars with the expectation that it will depreciate against the Japanese yen. So I hope this is making sense to you a little bit now, okay? Let's do one more example. Let's take the Forex quote GBP USD. In this example, the Great Britain pound is the base currency, right? And thus the basis for the buy or the sell. And if you believe that the British economy is going to continue to do better than the growth of the economy of the USA, then you would execute a buy order on the Forex quote GBP USD. And by doing this, you've just bought pounds with the expectation that it will rise against the United States dollar. And on the contrary, if you believe that the British economy is slowing down while the American economy continues to speed up, then you would execute a sell order on the Forex quote GBP USD. And by doing this, you've just sold pounds with the expectation that it will depreciate against the United States dollar, okay? So let's talk trading in lots. I'm pretty sure you guys have heard lots before, or lot size, right? What is that? So think about it like this. When you go to the grocery store and you want to buy an egg, you can't just buy a single egg, right? They come in dozens or lots of 12, right? I know some of you just had an aha moment. So in Forex, it would be just as foolish to buy or sell €1. So they usually come in lots of 1,000 units of currency, which we call a micro lot, right? Or 10,000 units, which we call a mini lot. Or 100,000 units, which is a standard lot. And all of this is dependent on your Forex broker and the type of account you have. But generally speaking, these are the units and their conversions, okay? And we'll cover more on lots and lot sizes in later lessons. So I don't have any money to buy 100,000 units. Can I still trade? Well, the answer is yes. And you can do this by using leverage, okay? Now, let's talk margin trading, all right? What is margin? Margin is the money borrowed from a Forex broker to buy or sell a currency pair, right? And when you trade with leverage, you wouldn't need to pay the 100,000 euros up front like in the previous example. Instead, you'd put down a small deposit, what we call margin. But what is leverage, Greg, right? What is leverage? Leverage is the ratio of the transaction size or position size to the trading capital or account balance used for margin. Let me repeat that because we've spoken about leverage before in the past. It comes up a lot. You're going to continue to hear this over and over and over again. So it's really important for you to really understand what leverage is. So leverage is the ratio of the transaction size or position size to the trading capital or account balance, which is used for margin, right? And margin trading lets you open large position sizes using only a fraction of the capital that you would normally need. This is why we call it leverage. So let's take 1 to 50 leverage, for example. What does that mean? This simply means that $2,000 of margin deposit is required to open a position size worth $100,000. Right? Let's look at 1 to 500 leverage. What does that mean? This simply means that $200 of margin or deposit is required to open a position size worth $100,000. So it's obvious that with the higher leverage you have, the less capital you need in order to open up specific position sizes. So leverage as an advanced trader, not as a beginner trader, not when you're just getting started, but as a seasoned trader that has the confidence, that has the understanding, right? That has the knowledge and education base, that person can take full advantage of leverage. Understanding the risk is also included, right? Leverage isn't only about the profits, it can just as equally hurt you. So that's very important for you guys to understand. So when you decide to close a position, the margin or deposit that you originally made, it's returned to you. And a calculation of your profits or your losses, it's done. And this profit or loss is then credited to your account. Okay? So I hope this video was helpful. I hope you guys got value from this video. I hope this video taught you and is going to encourage you to know exactly when to buy and when to sell a specific currency pair. So again, I hope this video was helpful, and I'll see you guys in the next one.